Let me ask you a simple question that most people get wrong. Would you rather have $1 million right now or a penny that doubles every day for 30 days? If you're like most people, your instinct screams, take the million. After all, a penny is worthless. But here's what rational thinking reveals: that penny doubling daily for just 30 days becomes over $5 million. On day 20, you'd only have about $5,000. On day 25, less than 200,000. But in the final 5 days, the compounding accelerates so dramatically that it dwarfs the $1 million option entirely. This isn't a trick question. It's a demonstration of how our minds are fundamentally wired to think incorrectly about wealth, time, and compounding. We evolved to think linearly in a world that operates exponentially. We're designed for immediate survival, not long-term wealth accumulation. And this mismatch between our intuition and reality costs people everything. The uncomfortable truth is this: most people fail financially, not because they lack intelligence and not because they lack opportunity. They fail because they lack the mental models and rational thinking frameworks necessary to make good decisions consistently over decades. They let emotions, social pressure, and cognitive biases drive their choices. They optimize for feeling smart today rather than being wealthy tomorrow. Warren Buffett once observed that investing is simple but not easy. The same applies to wealth building in general. The principles are straightforward. The math is elementary. But the psychology is brutal. Rational thinking is the bridge between knowing what to do and actually doing it for long enough that it matters. Most financial advice focuses on tactics: which stocks to buy, what percentage to save, how to pick real estate. These details matter, but they're secondary. The primary determinant of financial success is the quality of your thinking process. Get the thinking right, and the tactics follow naturally. Get the thinking wrong, and no amount of tactical knowledge will save you. Rational thinking in the context of wealth building means several things. First, it means understanding reality as it is, not as you wish it to be. Second, it means making decisions based on probabilities and expected values rather than stories and feelings. Third, it means designing systems that account for your own psychological limitations. And fourth, it means having the intellectual honesty to admit mistakes quickly and change course. The investors who build lasting wealth share certain thinking patterns. They think probabilistically. They understand compounding deeply, both its power and its requirements. They know the difference between price and value. They recognize their circle of competence and stay within it. They invert problems to avoid disasters rather than just chasing success. And perhaps most importantly, they understand that getting rich slowly is the only reliable way to get rich at all. Wealth is deceptively simple mathematically. At its core, you have one equation: what you earn minus what you spend, invested at a given rate of return over a specific period of time. That's it. 4 variables: earn more, spend less, invest the difference at decent rates, and give it enough time. Anyone can understand this, but understanding and implementing are different universes. The reason this simple equation produces wildly different outcomes for different people has nothing to do with the math and everything to do with thinking. Rational thinking means optimizing all 4 variables simultaneously with a clear understanding of which ones you can control and which ones you cannot. Let's start with earnings. Your income is partially within your control and partially not. You can develop valuable skills, work in growing industries, negotiate effectively, and build a reputation. But you cannot control the entire economy, your company's fortunes, or many external factors. Rational thinking means maximizing what you can control while accepting what you cannot. It means investing in yourself systematically, the same way you'd invest in a stock you believed would appreciate over time. Now consider spending, which is almost entirely within your control. This is where rational thinking creates the biggest advantage because most people are spectacularly irrational about spending. They suffer from lifestyle inflation, status competition, hedonic adaptation, and a complete failure to distinguish between price and value. Rational thinking about spending starts with a simple question. What is this purchase actually buying me in terms of life satisfaction per dollar? Not what does it signal to others, not how it makes me feel in the moment of purchase. What does it actually contribute to my sustained well-being? The mathematics of spending are brutal. If you earn $100,000 per year and spend $90,000, you save 10%. If you spend $80,000, you save 20%. That $10,000 difference in spending has the same impact on wealth accumulation as earning $10,000 more, but it's often far easier to achieve. Yet people agonize over salary negotiations while mindlessly spending thousands on things they barely value. Here's where it gets interesting. The psychological research is clear that beyond a certain threshold of material comfort, additional spending produces remarkably little additional happiness. Meanwhile, financial security, autonomy, and the absence of money stress produce enormous improvements in life satisfaction. Rational thinking means recognizing this asymmetry and acting on it. Spend enough to be comfortable and secure. Beyond that, every dollar spent is a choice to prioritize consumption today over freedom tomorrow. The third variable is the rate of return, and this is where most people waste enormous mental energy on low-value activities. They obsess over finding the perfect investment, timing the market, or beating the index by a few percentage points. This is largely irrational because for most people, the rate of return is the least controllable variable and also the one that matters least in the early years. If you're saving $10,000 per year, the difference between an 8% return and a 10% return is $200 in year one. The difference between saving $10,000 and saving $15,000 is $5,000. In the accumulation phase, your savings rate dominates. In the preservation phase, your returns matter more. Rational thinking means focusing energy where it produces results. The fourth variable is time, and this is the one that truly separates rational thinkers from everyone else. Time is the ultimate non-renewable resource in wealth building. You cannot buy more of it. You cannot reclaim it once spent, and it's the variable that makes all the others work through the power of compounding. Charlie Munger repeatedly emphasized that the first rule of compounding is to never interrupt it unnecessarily. Every year you delay investing is a year of compounding lost forever. If you start investing at 25 instead of 35, that 10-year head start can easily mean several $100,000 more at retirement, even if you never invest another dollar after 35. This is not speculation. This is arithmetic. Charlie Munger frequently said that it's remarkable how much long-term advantage people like him have gotten by trying consistently not to be stupid rather than trying to be very intelligent. This is a profound insight about wealth building. Most financial failure comes from unforced errors, not from missing opportunities. The rational approach to wealth is fundamentally defensive. You win by not losing. This requires adopting mental models that help you avoid mistakes. The first is inversion. Instead of asking, how do I get rich? Ask, how do people lose all their money? The answers are illuminating. They take on debt they cannot afford, often for depreciating assets. They invest in things they don't understand because everyone else is doing it. They panic sell in downturns. They confuse a bull market with genius. They fail to diversify. They trust the wrong people with their money. They make permanent decisions based on temporary emotions. If you systematically avoid these mistakes, you're already ahead of most people. You don't need to find the next Amazon. You just need to not do the stupid things that destroy wealth. This is inversion in practice, and it's one of the most powerful thinking tools available. The second mental model is understanding your circle of competence. You have areas where you genuinely understand the fundamentals and can make informed judgments. You have far more areas where you don't, even if you feel like you do. Rational thinking means operating within your circle and being brutally honest about where its boundaries lie. Most people overestimate their circle of competence dramatically. They read a few articles about cryptocurrency or biotechnology and convince themselves they understand it well enough to invest significant money. This is not rationality. This is ego combined with overconfidence bias. The intelligent approach is to either stay within your circle or expand it slowly and carefully through genuine study before committing capital. Buffett has generated extraordinary returns, largely by staying within a relatively narrow circle of competence and saying no to everything else, even when it was wildly popular. This is not a limitation, this is wisdom. You don't need to understand everything. You need to understand a few things deeply and avoid the things you don't understand. The third mental model is thinking probabilistically rather than in certainties. Nothing in investing or wealth building is guaranteed. Everything is a probability distribution. Rational thinkers ask, what are the range of outcomes? What are the odds of each? And what is my expected value? This mental shift is difficult because our minds prefer stories to statistics. We want to believe we know what will happen. We want certainty, but certainty is an illusion. The rational approach is to make decisions that have favorable odds when repeated many times, even though any individual instance might fail. The fourth mental model is second-order thinking. Most people stop at the first-order consequences of their decisions. Rational thinkers ask, and then what? They trace the chain of consequences multiple steps out. Consider taking on debt to buy a new car. First-order thinking says, I get the car I want right now. Second-order thinking asks, what does this commit me to? I now have a monthly payment that reduces my cash flow for years. That reduced cash flow means less ability to save and invest. Less investing means less compounding. I also own a rapidly depreciating asset that requires insurance, maintenance, and fuel. The rational thinker sees that the true cost of this decision is not just the car payment, it's the opportunity cost of everything else that money could have done over the same period. It's the stress of the obligation. It's the reduced flexibility. Second-order thinking reveals that many purchases that seem affordable are actually quite expensive when you trace all the consequences. The fifth mental model is understanding incentives. Charlie Munger called the incentive structure the most powerful force in the world. If you want to understand why people do what they do, follow the incentives. Rational thinking means always asking, what are the incentives here, and how might they be influencing the advice I'm receiving? When someone stands to profit from your choice, their advice automatically becomes suspect, no matter how well-intentioned they might be. Compounding is the most powerful force in wealth building, but it's also the most psychologically difficult to exploit. The math of compounding is elementary. The psychology is where almost everyone fails. Here's why. Compounding is non-linear and backloaded. For the first decade or two, the results feel disappointing. You're saving diligently, investing consistently, and your portfolio grows, but slowly. It doesn't feel transformative. This is when most people give up, chase higher returns through speculation, or convince themselves that patient investing doesn't work. But this is exactly backward. The early years are when you're building the base. You're not supposed to see dramatic results yet. You're planting trees that will bear fruit later. The person who understands compounding rationally knows that year 5 is more valuable than year 1. Year 10 is more valuable than year 5, and year 30 is more valuable than all the previous years combined. Let me illustrate with numbers. Suppose you invest $5,000 per year at a 10% annual return. After 10 years, you've contributed $50,000 and your portfolio is worth about $80,000. Nice, but not life-changing. After 20 years, you've contributed $100,000 and your portfolio is worth roughly $280,000. Getting more interesting but still not wealthy. But after 30 years, you've contributed $150,000 and your portfolio is worth approximately $820,000. After 40 years, $150,000 in contributions has become over $2 million. Notice what happened. The gains in the final decade exceed all the gains from the first 3 decades combined. This is compounding, and it's completely non-intuitive. The rational response to understanding this is patience. You must give compounding time to work. You must not interrupt it for temporary reasons. You must trust the mathematics even when the results feel slow. This is extraordinarily difficult psychologically because humans are terrible at intuiting exponential growth. The psychological challenges of patience in wealth building are multiple. First, there's the constant temptation to compare yourself to others who seem to be getting rich faster. Social media has made this exponentially worse. You see someone claim they tripled their money in cryptocurrency or made a killing in options trading. What you don't see are the dozens who lost everything trying the same thing. Rational thinking means understanding survivorship bias. The people loudly advertising their wins are not a representative sample. For every winner in speculation, there are many more quiet losers. The sustainable path is boring and therefore invisible. Nobody brags about investing in index funds for 30 years. But those people end up wealthy while the gamblers end up broke. The second psychological challenge is loss aversion. Psychologically, losses hurt about twice as much as equivalent gains. Feel good. This means that when markets drop, the pain is intense and the temptation to sell is overwhelming. This is precisely when you must do nothing or ideally buy more. But our emotions scream at us to eliminate the pain by selling. Rational thinking means preparing for this in advance. Markets will drop. You'll feel terrible when they do. So you decide your strategy in advance when you're calm and you commit to it. You automate your investments so they continue regardless of how you feel. You design your system to account for your predictable psychological weaknesses. The third challenge is the desire for activity. Doing nothing feels lazy. Letting your investments compound in boring index funds feels unsophisticated. This is ego talking, not rationality. The data is overwhelming that for the vast majority of people, including most professionals, active trading and market timing subtract value after costs and taxes. One of the most important distinctions in building wealth is understanding the difference between price and value. Price is what you pay. Value is what you get. They are related but not the same, and confusing them is expensive. This applies to everything, not just stocks. When you buy a car, the price is on the sticker. The value is the transportation, utility, and satisfaction it provides over its lifetime relative to alternatives. Rational thinking means always asking, am I getting good value for this price? Most people skip this step. They see something they want, they can afford the price, and they buy it. They never seriously consider whether the value justifies the price. The stock market offers a perfect laboratory for understanding price versus value, because both are quantified and visible. A company has an intrinsic value based on its future cash flows, competitive position, and growth prospects. The stock has a price based on supply and demand, which is driven by emotions, narratives, and momentum as much as by value. Sometimes price and value align. Often they don't. The rational investor's advantage comes from recognizing when they've diverged significantly. When price is well below value, you buy. When price is well above value, you sell or avoid. This principle extends beyond stocks to all of life. Real wealth is not the monetary value of your assets. Real wealth is what those assets can do for you. Its autonomy, its security, its options, its freedom from financial stress. It's the ability to spend time how you want rather than how you must. Many people get this backward. They accumulate expensive things that have high prices but deliver relatively little actual value in terms of life satisfaction. Meanwhile, they underinvest in things that have enormous value but modest prices like financial security, health, relationships, and personal development. Charlie Munger lived in the same house for decades, drove modest cars, and lived well below his means despite being a billionaire. This wasn't because he was cheap. It was because he understood that beyond a certain point, more expensive things didn't provide more value. Meanwhile, he spent freely on books, learning, and relationships because those had enormous value. The mathematics of wealth building are unforgiving in one critical way. Losses hurt more than equivalent gains help. If you lose 50% of your capital, you need a 100% gain just to get back to even. This asymmetry makes avoiding large losses essential, yet most people focus overwhelmingly on potential gains while paying insufficient attention to risks. Rational thinking about wealth must start with survival. You cannot compound wealth if you don't survive. This seems obvious, but people violate this principle constantly. They take risks that could wipe them out in pursuit of returns that would merely make them somewhat wealthier. The math doesn't work. Consider leverage, which is borrowing money to invest. In rising markets, leverage amplifies gains. This feels wonderful and creates an illusion of genius. But leverage also amplifies losses, and it can create situations where you're forced to sell at the worst possible time. Many intelligent people have been destroyed by leverage, not because they were wrong about the direction of the market, but because they underestimated the volatility. The rational approach to leverage is extreme caution. For most people, the answer is simply to avoid it entirely in their investment portfolio. Charlie Munger often said that there are 3 ways to go broke: liquor, ladies, and leverage. He was only half joking. Leverage is seductive because it works wonderfully until suddenly it doesn't. This connects to a broader principle. Position sizing matters enormously. Even good investments should not represent such a large portion of your wealth that a single failure would be devastating. Diversification is often misunderstood as a way to maximize returns. It's not. It's insurance against your own ignorance and against bad luck. You will be wrong sometimes. This is guaranteed. The question is whether you'll survive being wrong. The rational thinker understands that uncertainty is irreducible. Therefore, you must structure your portfolio and your financial life to be robust to being wrong. This means diversification, this means avoiding leverage, and this means maintaining adequate insurance. Knowledge without execution is worthless. You can understand every principle in this video, agree with all of it, and still fail financially if you cannot actually implement it. This is where discipline and systems become critical. The uncomfortable truth is that humans are not naturally disciplined. We're emotional, impulsive, inconsistent, and easily swayed by our environment. Relying on willpower and discipline alone is a recipe for failure because willpower is a finite resource that depletes under stress. The rational approach is to design systems that make the right choices automatic and the wrong choices difficult. Consider saving and investing. The undisciplined approach is to spend what you want and save whatever is left over at the end of the month. This fails because there's rarely anything left over and because it requires constant willpower to resist spending. The disciplined approach is to automate transfers from your checking account to your investment account on the day you get paid. The money is gone before you can spend it. You never have to exercise willpower. The system makes the right choice for you. These might seem like small tactics, but they compound over time just like money does. Every system you put in place that makes good decisions automatic is a permanent improvement that continues to benefit you with zero ongoing effort. Every system that prevents bad decisions is permanent protection against your own weaknesses. The rational thinker recognizes that humans have predictable flaws and designs around them. We're loss averse, so we need systems that prevent us from selling in downturns. We're present biased, so we need systems that force us to save for the future. We're influenced by our peer group, so we need to be thoughtful about who we spend time with. The power of systems is that they reduce the number of decisions you have to make. Every decision is an opportunity to make a mistake and an expenditure of mental energy. If you have to decide every month whether to invest and how much, you'll make different decisions based on your mood, what's happening in the markets, and what you read that week. Most of those decisions will be suboptimal, but if you've set up a system where a fixed percentage of your income automatically goes into a diversified portfolio every month, regardless of market conditions, you've made one good decision that executes itself forever. You've eliminated dozens of opportunities for error. This is rational design. Perhaps the greatest advantage available to the rational investor is the willingness to think long-term in a world that's obsessed with the short-term. This isn't easy, but it's enormously valuable precisely because it's difficult. The world around you is designed to encourage short-term thinking. Financial media reports market movements every day, even though daily movements are essentially random noise. Companies report earnings every quarter. Social media creates constant comparison with others and pressure to show visible results immediately. All of this is working against patient, long-term wealth building. The rational response is to consciously opt out of short-term thinking and design your life around long-term goals. This starts with defining what long-term means to you. For wealth building, long-term generally means decades, not years. Your investment horizon should match your actual timeline. If you won't need money for 30 years, it should be invested based on what will maximize value over 30 years, not what will look good in 6 months. This has profound implications. It means you should ignore daily market movements entirely. It means you should be grateful for market downturns because they let you buy assets at better prices. It means you should think about investment decisions in terms of where you'll be in 10 or 20 years, not where you'll be next quarter. Long-term thinking also means being willing to look foolish in the short term. When everyone around you is getting rich quickly in some speculative bubble and you're plodding along with your boring index funds, you will feel left out. You will question yourself. You will wonder if you're being too conservative. This is the test. The rational response is to remember that speculation looks like genius in bull markets and foolishness when it crashes. The fact that something is working right now tells you nothing about whether it will work long term. Long-term thinking means having the confidence to stick with sound principles even when they're temporarily out of fashion. If you've made it this far, you're clearly serious about building wealth through rational thinking rather than hoping for luck or following the crowd. That puts you ahead of most people already. This channel exists to explore these ideas in depth, the mental models, the psychology, the practical frameworks that separate successful long-term investors from everyone else. If this approach resonates with you, I genuinely appreciate if you'd like this video and subscribe to the channel. There's no hype here, no promises of quick wealth, no promotion of specific stocks or schemes, just timeless principles applied thoughtfully to the challenge of building wealth over a lifetime. Let me leave you with a final thought. The principles we've discussed today, rational thinking, patience, discipline, long-term perspective, understanding compounding, avoiding stupidity rather than seeking brilliance, these are not complicated. A reasonably intelligent person can understand them in an afternoon. But understanding is not the same as implementing. Implementation requires sustained effort over decades. It requires making good decisions consistently when they are boring and unglamorous. It requires resisting temptations that are everywhere. It requires thinking clearly when everyone around you is panicking or euphoric. This is hard, but it's not impossible. Thousands of people do it successfully. The difference between those who succeed and those who don't is not usually intelligence, luck, or circumstances. It's simply the willingness to think rationally and act on that thinking consistently over time. The wealth you build is almost a byproduct. The real achievement is becoming the kind of person who can think clearly, delay gratification, resist social pressure, and make sound decisions under uncertainty. Those capabilities are valuable in every area of life, not just finance. So yes, rational thinking builds wealth over a lifetime, but more importantly, it builds a rational life. It builds autonomy. It builds peace of mind. It builds the confidence that comes from knowing you're making good decisions for good reasons. The world will continue to be chaotic, uncertain, and often irrational. Markets will boom and crash. Trends will come and go. Through all of it, the rational thinker stays focused on fundamentals, maintains perspective, and continues making sound decisions. That's the path. It's not the most exciting path. It's not the fastest path, but it's the most reliable path we have. Start where you are. Use what you have. Do what you can. Think clearly. Act rationally. Be patient. The mathematics will take care of the rest. Thank you for watching.